The issue again is I think we have had a bit of supervisory failure here, right? Because we all know this in any industry. If you let capitalism go totally unchecked, shareholders will demand immediate profits today. It happens in every industry, except in ones where you can basically gamble on future profits, and that's what tech does. But every other shareholder in every other asset class demands money today, and that's the same for banks. The problem is the banks are a highly regulated business. They are supposed to be supervised by the regulators. And this is a very clear example where why is there not a real-time spreadsheet? I mean, this is not complicated stuff where assets and liabilities and duration mismatching can be known on a real-time basis, where the San Francisco Fed, Mary Daly, should have a report that's escalated to her when SVB got over their ski tips, which they did in Q4 of 2022. So I think the real question that has to be examined is where were these folks for the last 4 months when they could have done something, not just about this, but rules in general for all banks that are not the GSIBs? And I think that's a very important question that politicians need to get to the root of.
The financial collapse has shook up the world markets, and there has been a lot of finger-pointing. 5 banks have either failed or received government support in the past few weeks. The First Republic Bank, Silvergate, Silicon Valley Bank, Signature Bank of New York, and Credit Suisse. The Federal Reserve is being criticized by many for increasing interest rates so quickly, while others blame poor management and venture capitalists for the bank run. Whatever the cause, it appears that this is only the start of a protracted path to recovery. Chamath Palihapitiya voiced his worry about the situation in his podcast. The government's provision of backstops, in Chamath's opinion, is merely putting the problem off until later. According to Chamath, we should mark the calendar for 1 year from now because that is when we will be able to observe the effects of what is presently taking place. Listen to Chamath's perspective first.
So what the Fed did this weekend is essentially create a buyer of last resort again. Now, how did they do this? So all of these banks basically have assets that they bought for $1 and are now worth 95 cents. And that's what's creating this whole issue, or 80 cents or 85 cents. You pick the number, but they're not worth the $1 that they bought it. What the Fed basically said is, okay, give me that asset, give me that bond. I will value it at $1 and I will give you $1 as a loan and you will pay me interest. And the interest rate, I think, is what's called OIS, and they added 10 basis points on top. So I think it's about 4.9%. So what it allows all of these banks, and if you take all of the banks that are not the top 4 in America, so the top 4 are JP Morgan, B of A, Citi, and Wells. So just ignore those for 1 second. The other N banks, if you look at all of the assets that are underwater because of all the rate hikes that Sachs talked about, and you add up all those losses, that is about $2 trillion. And the Fed didn't announce that there was a beginning and an end to this program other than saying these would be 1-year loans. And so I think the exposure for the American banking system at a minimum is going to be this $2 trillion, because now the incentive, if you're a banker right now running one of these banks that has not gone under, is to immediately go to the Fed, put all of those assets to them, get a loan, and now take that and buy different assets, different bonds, different US treasuries that are yielding much more than what your old treasuries were yielding. And I think that's the arbitrage that we've unfortunately created. And the other question now, though, however, is what does that mean for the top 4 banks, right? Because if it's $2 trillion for everybody else but the top 4, what's the gap for the top 4? That looks like it's somewhere between $1 trillion and $2 trillion. So that's another amount of money we're going to have to, or the Fed will have to backstop. And then, as Friedberg said, these checks always come due. What do we do in a year? Because in a year, the problem is the only way to make the banks in a position to repay this much money in 1 year is to cut interest rates so massively that these assets massively inflate, and now all of a sudden you're in a position to cover this. Again, it depends on what they bought. We don't really know enough detail, so I don't want to guess. But if you own these 10-year treasuries, you could be off 10 or 15%. If you own mortgage-backed securities, it could be off a little bit more. If you own short-term securities, they're off a little bit less. You get a loan collateralized by these assets. So you're still holding them, right?
Yes, and they mature.
So if the Fed takes an emergency posture and says, okay, guys, we want to avert a crisis in a year from now, and we're going to cut rates, these assets that these banks own will be worth more, which will allow them to repay the loan. As far as I can tell, all we've done is we've kicked the can down the road for a year. But I do think it's important for people to realize this doesn't solve the problem. It just means that mark your calendar for a year from now. We have a problem on March 15th, 2024, because all those folks that took money, what do we do? Every for-profit business is in the business of making money, and there are physical costs that you have to bear. In the case of a bank, there is physical infrastructure, literally bricks and mortar, that go into making the branches. There are lots of people. There is lots of software. There's lots of complex back office and middle office things that banks have to do in order to accept money. That has a cost. So I don't see how it will be very easy for somebody to create a bank that just stores your money for you without you being charged quite a lot of money, unfortunately. I think that there has to be a different way to solve this problem. And I think that what we did after the great financial crisis was the regulators wrote down all kinds of new rules. But the crazy thing in 2008 were those rules were written on paper. And now we're in 2023 and these rules can be written in software. And so I think what it requires is some amount of tactical real-time intelligence that regulators need to have over those that they regulate. And I don't know why we're so afraid of demanding that the next time some of these complicated real-time laws are written in law, that they also need to get written in code. And I think that that's a practical solution. It should be the case that every bank that's supervised by the Fed has a dashboard that has all of the key levers that allows what you said, Jason, to happen, which is a real-time mark-to-market. Should those or should they not be disclosed to shareholders? That's a different discussion. But the regulators should have 100% transparency into how these organizations run because, as Sachs said, they are an enormously critical institution that, at best case, after this fiasco, what we've realized is very poorly misunderstood by consumers. And that at the worst case is being mismarketed to us. Yeah. And I think that shouldn't be allowed.
If you thought the information was useful, please take a moment to hit the like and subscribe buttons below to show your support for our small channel. That's it, guys. We appreciate your interest and hope to see you at the next one. Thank you for watching.